The 360 on Energy and Carbon, hosted by 360 Energy. Following a successful career on the New York Mercantile Exchange, Stephen Schork transitioned to an upstairs trading operation. He quickly realized that the demise of open outcry on the commodity futures exchanges eliminated the transparency of deal flow. In response to this void, Stephen developed proprietary multivariate probabilistic models to identify statistically significant ranges at which to trade energy products and/or hedge exposure. In 2005, Stephen co-founded the Schork Group, the industry's premier provider of price range forecasting and independent fundamental, quantitative, and technical analysis. Central to the company's product suite is the Schork Volatility Bands, SVB. Professionals in the global energy arena rely upon this methodology to improve economic performance and manage risk. Stephen is a registered commodity trading advisor with the National Futures Association. Now let's get into the episode with Stephen, principal and editor at the Schork Group.
I love the discussion and the words going, because we're going to revisit this with you as we go forward, because I think there's a lot of layers here. I want to bring you back to natural gas. And I want to discuss, you actually mentioned the idea of that terminal that is going to be, we thought it was supposed to be scheduled. And my notes have disappeared, but I think it's Freeport. I always get that mixed up.
That's correct. Yep, Freeport LNG. Yeah. That is correct.
Right. So our understanding is it was going to open up November. You had mentioned the first quarter, so you might have more up-to-date information with that. So is that the most up-to-date information that won't happen until the first quarter of 2023? And if that's the case, I can see how it would be kind of bearish here. We'll keep, as you suggested, gas pricing pretty, because we're going to keep gas in North America. But when it opens up, whether it's November or the first quarter, how do you think pricing is going to go in North America based on that terminal opening up?
Yeah, absolutely. So what we can promise, or what I can promise you is it will continue to maintain the high level of volatility. I'll give you, for instance. So when the Freeport LNG export facility went down back in June, it had a tremendous bearish impact on U.S. natural gas prices. U.S. natural gas prices began to rebound, and about a month ago, in one day, we saw natural gas prices trade above $10 per MMBTU, which is the equivalent of over $60 barrel crude oil. Okay, in that one day, we went from $10 a decatherm in the morning, and a couple of hours later, when Freeport announced that the expectation of that October partial restart was now being pushed back to the late November, natural gas prices in a couple of hours dropped from $10 a decatherm to just above $9 a decatherm. And again, I want to add, in a couple of hours. What does that mean? Well, the natural gas trading on the NYMEX dropping from $10 to $9, that was a change in value in that contract of almost $10,000 in one contract being traded, just one contract. Now, large trading houses, proprietary desk, they trade hundreds of thousands of contract positions that they have on their books. And you have a 500 or a 1,000 or 2,000 contract position for a market that can change $10,000 per one of those contracts multiplied, gives you the impact on volatility. So the Freeport is having that impact. And certainly when those molecules come on. Now, when I alluded to first quarter, that is the rumor in the market, and markets trade on rumors. Freeport has not changed its stance, but even if it does come on in November, I want to make this clear. It's not going to be its full production. It's going to be a partial return. So we're still looking well into the first quarter before Freeport is fully up and running. The other concern in the market is Cheniere. Cheniere is another company. They're the largest exporter of LNG. They command 50% of the U.S. LNG market. Now, when they built their export facilities, they built a unique turbine in that facility that they did not think was going to be, the emissions from these turbines were never under scrutiny by the EPA. So for the past 20 years, the emissions from these turbines were excluded from EPA regulations. Well, lo and behold, Cheniere invested in these turbines. These turbines now are generating emissions, and the EPA has changed cost and has come after Cheniere saying, you have to do something about these emissions. So now the fear is that a portion of that half the U.S. export market will be impacted as Cheniere is now being forced to make the necessary requirements to bring these turbines onto spec. So if we get Freeport back on, there is that sword hanging over the export market of what happens to Cheniere. But once that situation, the market can digest that news and we have some clarity on that. And if that clarity is Cheniere's exports are not impacted in conjunction with Freeport coming on, it will once again have a long-term bullish impact because now what I'm dealing with here in the United States for my natural gas, I'm now competing with the Europeans. I'm now competing with consumption in Asia. Now, on top of that, what we have here is the idiotic notion that we are now banning the consumption. The state of California just came out 1 or 2 days ago, and by the end of this decade, new residential consumption cannot have natural gas hookups. So this is mind-boggling because if you're going to artificially manipulate demand for natural gas, you're going to artificially manipulate the investment in natural gas. California cannot even keep the lights on now, but by 2035, every vehicle in California will have to be electric. So between now and 2035, 30 million cars will have to be connected to the grid in California. As I said, California cannot keep the lights on today. The infrastructure is not there to ramp it up over the next 13 years when these 30 million cars are going to be fully linked to the grid. And we're encouraging or discouraging investment in natural gas to create this electricity. Renewables will not be there. So it has the knock-on effect. The energy impacts every aspect of our lives, not just the way we move around in vehicles. As I said before, it impacts our consumption of food. It impacts our consumption of consumer goods because the petrochemicals that are derived from crude oil go into virtually everything from the clothes on our back to the desk that we're sitting on to the plastics surrounding our computer screens. Energy impacts it all, and fossil fuel energy impacts it all. So as we continue to maintain this fight against fossil fuels without having a reliable renewable background, just sets the tone for higher volatility prices. So events like Ukraine, events like Freeport LNG, events like Cheniere will continue to have an outsized impact on energy prices and therefore have an outside impact on consumption and economic consumption. And here and in Europe, economic consumption or consumer spending is the driver of our economies, and we are making it that much harder to drive the growth in our economies.
Thank you for that. As you know, I'm an observer of the North American market, not a participant of it. But I do note that I've got to get myself an extra sweater to cope with the heating here. You're absolutely right. Although the other balance that's interesting, of course, we don't have the aircon demand that you have. So I think high energy prices are going to impact certainly residential over the winter. But going back to North America, I get what drives the commodity cost of natural gas, but what's driving the transportation costs? And, what's involved in that? Where's it going?
Yeah, absolutely. Well, first and foremost, it's the cost of electricity. Something has to be burned to create electricity. And more, what has happened is we are burning natural gas. So the impact for our transport costs are being directly impacted by the price of natural gas vis-a-vis the price of power. So I'll give you, again, an anecdote. 20 years ago, I was a buyer on a trading desk for a utility for the deregulated power and gas utility. And at that utility, part of my responsibility was to analyze the cost of the BTUs of what we were going to buy, what we were going to burn to generate our electricity. We had coal plants. We had an oil fired plant, and of course, we had natural gas plants. Now, I've started my business back in 2005, but that utility no longer has coal. It no longer has oil. It only has one commodity it can burn, and that is natural gas. So when you trap your demand and you take out that substitute, because there are two things in economics that drive price. It is consumer behavior and it's substitutes. By consumer behavior, I mean price shocks. Now, in the energy corridor, going back to the Arab oil embargo in the early 1970s, we've had boom and busts, but they've been short-lived. So we've had those booms, the oil embargo in the early 70s, the Iran-Iraq war in the early 1980s, Saddam Hussein's invasion of Kuwait in the early 90s, the US war on terror and the wars in Iraq. They've had short-lived spikes in price, but then we've had those crashes, and consumer demand responded accordingly. On the spikes, demand fell. On the troughs, demand spiked. But the one thing that has changed is the other variable in that economic equation, and that is substitutes. Substitutes from a transport standpoint has been EVs. We never had EV. The other more recent impact of substitutes, or the quasi substitute, is the COVID mitigation protocols, where part of the elasticity of demand for gasoline was the fact that we had to drive to work. We had to drive our kids to school. That's no longer the case. Many companies have not returned to the office, will not return to the office. And the ones that have are not on a fully 5-day basis. They're going back 2-3 days a week. So that's impacted demand. So that's impacted the fossil fuel demand, because fossil fuels are still 95% of the transportation market around the globe. But as we begin to transition and increase our demand for EVs, we increase our demand for electricity. Therefore, we increase our demand for a market, a BTU market that no longer has nearly the amount of substitutes, be that coal or nuclear. So as we increase our demand for electricity, we increase our demand for natural gas, which will keep prices higher and which will keep our costs. We'll continue to raise our costs as we charge our cars. And right now, the economics, as I said before, the economics are no better in Europe than they are for gasoline. And when you take the tax on gasoline out of Europe, the economics don't compete with gasoline. We're not quite there in the United States, but we've certainly set our road on the price that the higher demand for power, higher demand for natural gas, therefore the higher price that will impact the transportation market.
It's quite interesting. Just as you started explaining the transportation cost, I'm going, "Oh, of course. How do you move gas?" But yeah, that just shows even when you're in the business, you can start to overlook something. So thank
Forest
you for
through the
that.
trees, right?
Yeah, yeah.
Now, I've kind of heard you answer this question a little bit throughout the episode, but is the move to more electrification beneficial to higher gas storage levels?
No, it's what has happened here is the natural gas market up to the 1990s was a one-season market. You put your gas into the ground in the summer when consumption was low, because you had these substitutes for electricity generation for air conditioning, which of course is greater impact in the United States than it is in Northern Europe, with the amount of greater use of air conditioners in the United States and non-air conditioning in residents in Europe. And then what happened starting 20, 25 years ago, of course, now is the natural gas market is a two-season market. We have a significant amount of natural gas consumption during the summer for power consumption to keep air conditioners running. So it is a natural gas market that's always been vulnerable to the vagaries of weather-related demand. But now that window of demand is much, much smaller. So for instance, if we get a early start to cooling demand, whereas it usually doesn't pick up in great quantity until mid-June. Well, we've had instances where cooling demand for air conditioning, demand for natural gas, for power generation has really started, it could spike as early as late April and last into late September, early October. That's not the case this year, fortunately, but that certainly can be the case. And if you do get a situation where you have a longer than expected summer cooling demand, and we transition into an earlier start for heating demand, that use of natural gas, then that window to build supplies is that much shorter. So what happens in the natural gas market is, whether it's here in the United States or in Europe, is the majority of our natural gas goes into the ground at the start of the spring shoulder months. So the end of the winter, late March, early April, as we start putting gas into the ground and we max out that supply, or that's when we see our greatest quantity go in, is in the months of April, May, and into early June. That storage bill then fall off during the dog days of summer, and then rebuild again and restart in mid-late September when it starts to cool off, which is the situation happening right now. But it is a season by season situation that, yes, the weather gods are working in our favor right now, assuming we don't get an early start to winter demand. But that changes a year in, year out. And as we continue our consumption for electricity, be that through transportation, or as in the case of in California, not only are you artificially increasing the demand for transportation on EVs, but by this mandate of outlawing new natural gas consumption in 2030, you're going to once again that you're going to have to consume something, and that's going to be even more electricity, which will continue to have an outsized impact on storage and will keep storage. And so now it's a question: can U.S. production, can global production of natural gas compete now with this increased demand for natural gas? And so that will be the yin and the yang that petroleum economists and traders like myself will have to navigate, and it'll be on a season by season basis.
So next question is about the impact of gas on the power market. And it's a simple question, but I'm guessing it may not have a simple answer, but it's along the line. Are higher gas prices driving grid investment in lower carbon and renewable alternatives to replace it?
Right now, that was the move that that ESG crowd is promoting and being backed by the current administration and the current Congress. But as we saw with Europe, and that was the move that we were seeing back in Europe up until last February, and now you're starting to see there's just so many dollars that are out there. And Thomas Sowell's definition of economics is scarcity. We're never going to produce enough of what everybody wants. And so we need a mechanism to balance those wants and those needs. And of course, that mechanism is in price. So there are just so many dollars, scarcity dollars, that either have to go into renewable grid investment or into maintaining increase in fossil fuel investment. And as we saw in Europe, it's been a sea change where we've gone, that ESG crowd is now muted, and those dollars are going into, say, instead of renewable grid and storage methods, going into building import facilities for liquefied natural gas. It will be the same situation here in the United States, where we'll continue to invest. Private investment will continue, but private investment, the risk here, and what we're certainly seeing, is the fact that ESG investment doesn't make you any money. And if you're not making any money, at some point you're going to stop investing. And I'll give you a for instance. Harvard University is the oldest university in the United States. Okay. So it makes sense that it has the most money. It's been around for a long time, and it has an endowment of well over 50 billion, billion with a B, dollars. And it has been traditionally the wealthiest college endowment of any in the United States. The number two traditionally has been Yale University. Once again, that should make sense. Yale is the second oldest university in the United States, and they typically have an endowment, depending on how they invest each year, of over $30 billion. Well, this year, what has happened is the Yale, Harvard, and all your quote unquote elite universities have virtue signaled. They have cut their investments in fossil fuels. They've gone into renewables. And their endowments now reflect that, because they are not doing nearly as well as they've done in the past. Who has done well? The University of Texas school system, because the University of Texas system has maintained their portfolio, has maintained the acreage they oversee in West Texas in the oil and gas region, and their portfolio, their endowment has exploded to the point where they are now the second richest endowment. They've surpassed Yale. And when we have the final numbers, the assumption is they will surpass Harvard's $50 billion endowment, and the University of Texas now will be the wealth endowed college system in the United States, because their investments in fossil fuels are paying off where everyone else's investments are not. So you have to follow the money. The money will eventually, yes, you can have a certain amount of capacity invested in renewables, but as we've seen with the lousy earnings in these portfolios coming from Blackstone, there is a limit to how much money you want to pour down a rabbit hole. Your investors demand a return, and the return is not on ESG. The return is on fossil fuels. So that return is now being, of course, on steroids because of the lack of investment that the fossil fuels have received over the last couple of years, and that will continue to pay out. So the risk to the renewable grid is the fact that the renewable grid investment is not yielding any sort of returns. And my estimates is it's not returning any social, and that has been the argument that there's a social return, not an economic, not a monetary return, but a social return that you think you're doing something, or the perception is this is better for the economy. But as I stated before, with our current dependence on renewables and storage and battery technology and mining, we're not doing anything better for the economy. So an investment in ESG is a loser on both fronts. It's not giving you an economic return, a monetary return, and it's not giving you a social or an environmental return. It's a lose-lose. What is doing the winning is on a monetary basis. Of course, it's investment in fossil fuels, and you follow the money, and that will continue to steal back the dollars, to take back the dollars that were stolen from it with the move towards ESG over the last handful of years.
Thank you for that. It's a very interesting perspective.
So, Stephen, I really enjoy listening to your perspective. And that's why we're very fortunate to have this podcast, because we have different people who have different expertise and they come at it from so many different ways. It's refreshing to hear all these different perspectives. So I really appreciate your thought process here. This is
and I'm going to say, and I appreciate the opportunity to give my perspective. I know everyone listening on is not going to agree with me, but my intent is to give you food for thought, because we too many people have blinders on, and I don't have all the answers. But my suggestions are part of the answer, and there are other viewpoints that I respect and that I consider that, and I'll accept that. But we're in such a nasty political environment. If I can only be right if you're wrong, and we have to have a better understanding of a meeting in the middle in this economy and around the globe.
Absolutely.
You couldn't have said that better. Like that, that's absolutely the case. I'm going to ask the last question for myself. And again, you may have addressed or talked about this a wee bit, but I'll be specific. So are there any surprising changes or announcements in North American jurisdictions in regards to renewables, carbon reductions, et cetera, from electrical generation standpoint that you want to address or discuss with the audience?
Yeah, absolutely. My concern is that we continue to go down this path. And what I'm worried about is the market is doubling down. It refuses to accept the fact that renewable investment, while it is the way for the future and we should continue to do it, we're doing it at a zero-sum basis. And we're ignoring the elephant in the room, our continued reliance and our growing reliance on fossil fuels. And as we've just seen with the announcements in California, which, the ideas and culturally, economically, typically start in California and then they move across the country. And so California and the governor who's going to make a run at the White House the next election is doubling down on his proposal. So as we said before, it's the proposal to have 30 million cars hooked up to his beleaguered grid by 2035. It is banning the use of natural gas residential hookups. He's also, by 2025, you cannot have gas-powered lawn equipment, mowers and trimmers and so forth. So what that will do, not only from a residential consumption, but from landscaping companies, that they no longer. So all of those lawnmowers, again, will start being hooked up to the grid. And in time and again, we simply have the example that we cannot continue to go down this road. So what scares me is that we will, and it surprises me, because at some point I would have thought, especially in this environment, we would have had more of a compromise, but there is no compromise coming. And we continue to double down on a policy that continues to lead to higher prices for both gas and power, and will continue because, as I said before, we won't have a meeting of the mind, and we won't come together. And so that is my surprise, is that we continue to remain in our separate camps, and we're unwilling, or I should say I'm willing, and certainly with what we've seen with moves in the fossil fuel industry, they are making strides to be more environmentally conscious, and they are making significant progress, but they don't have a partner in this on the other side of the equation. And until we get that partnership, we'll continue to see outrageous headlines. Well, that just will continue to promote higher prices and greater volatility.
Well, it's been great having you on, Stephen. To conclude our episode, what are you predicting for this upcoming year?
If you're a Rocky fan, if you remember Clubber Lang in Rocky number 3, when his prediction for the fight was, it was pain. And that's my prediction for the energy markets going forward. I do think we are in a mild recession caused by inflation. Inflation has not been tamed. My fear is that we're going to see perhaps a greater drawdown in economic demand, which will have an impact on prices. So from a modeling standpoint, from a crude oil standpoint, we're already at the low end of my forecasting. My bearish case was $70 a barrel. And this was at a time when oil prices were trading consistently above $100 a barrel. My range at, excuse me, at that point was $100 a barrel. What was your valued price? And based on volatility, I was looking at a range of oil prices between $120, $125 a barrel on the high end and $90 and $85 on the low end. And so what does that mean? From a data science, from a financial engineering standpoint, this was your normal range, and we'll call that range 125 to 85. Once prices change above that 125 or below that 185, with your price modeling, that is telling you something. There's been a fundamental shift in the market. And now that U.S. oil prices are trading in that $70 range, that is now my bearish case. So going forward, the prediction is if we do, and this is our risk, if we do enter a significant recession over the next year, then we're looking at oil prices down back below $50 a barrel, $40 a barrel as that demand dries up. But again, in economics, if high prices are the cure for high prices, low prices are the cure for low prices. So as we continue to fall in price, the lack of investment will be there. And globally, there's still a structural imbalance. There's not enough supply to sate demand. That imbalance will be masked if we see a severe recession globally. But what that does set us up is for a return to those higher prices once that lack of investment goes forward because of low prices. So I do think we'll see prices depressed over the months ahead, but December will be the third strongest month outside of July and August for energy transportation fuel consumption. So I do think going into the fourth quarter, we run the risk of lower prices. We can see lower $50 in the new year, depending on the severity of the recession, but that only sets us up for higher prices. So lower for shorter, higher for longer. The potential, if we haven't bottomed here, which is where my modeling suggests we should be, if we break below here, then my concern about that fundamental shift will be verified. And I do think we can see below $50 a barrel, but that only sets us up for a return to the higher end of the market. And that will be oil back above $125 a barrel. And the modeling will change at that point because the fundamentals would have greatly changed. And we'll probably be looking at oil prices within the next year and a half, 2 years back, pushing that $150 barrel oil level. And you'll have the corresponding reaction, of course, in the natural gas market. The one difference being there is you'll have more of an outsized bullish effect on U.S. prices relative to Europe once U.S. LNG exports are back running at normal capacity.
Well, thanks again, Stephen, for another 2 great episodes. Dave, John, I want to give you some time to reflect and give our listeners your comments on today.
Yeah, sure. I mean, it's always interesting talking with Stephen on it. I mean, he takes a particular view that he's well informed on and really puts it forward well. And I've sort of come away from this thinking the energy markets are global and they're complex and they're not really controllable because you haven't got control over it. So what can our listeners do? And I think following his Economics 101 is probably reduce demand. You know, if you use less energy, you're going to be less exposed to the vagaries of the market. But yeah, I wouldn't want to be in the position of having to bet the house on where it's all going.
Yeah, well said, John. I actually, what came out of these discussions is I'm wondering, as Stephen has alluded, that policymakers make decisions, but do they truly understand the long-term implications? Have they really factored that out, and we know, John, from our experience, that people tend to look at things in the short term and not look at the longer term and the implications. And I think, as Stephen has alluded to, I think the future in the industry, customers are going to have to start thinking more long term when it relates to energy usage, energy policy. Going short term, I think that just is going to create a lot of volatility and pain, as Stephen suggested. So I'm really grateful, Stephen, that you were, sharing your expertise and time and exposing us to some of the realities that I don't think many people really understand. So I appreciate that.
And I do appreciate the opportunity to express these opinions. And to all your listeners, keep an open mind and take to heart things I've said. I know you're not going to disagree or agree with everything I've said, but keep it in the mix. We need to be. We're all in this. We all live on this earth together, and we all have to come together and be as one.
Yeah, fair
Well
comment.
said. All right. Thank you for your time, Dave, John, and Stephen.
All
Thank
right.
you
I
all.
look forward to the next time, guys.
Okay. Thanks, guys.
Thank you.
Bye.
Cheers.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn post. See you next week.